All throughout 2017, there was a foolproof strategy. Buy anything and everything and you will see profit. No problem. Too easy. Then 2018 came and the VIX trade everyone was doing suddenly broke. That was a huge wake-up call. Well, for about 15 minutes. Complacency came back and then we saw another huge shock in October. But complacency made another return in late December as traders piled into FANG stocks and other equities that were oversold. With consistent and never-ending statistics documenting the current slowdown, every single entity has suggested a recession will not happen. Strange, isn't it? You came here for the truth, so let me unveil that for you. Today we're going to look at complacency. I found this article out of Northman Trader, who I've shown before, and he really broke it down into several charts that he picked up from Bloomberg and other places, and it really tells a story. So I want to get into that today to show you what is really happening ever since late December up until now in January, and I think it's important to follow these economic statistics as time goes on. So let's get into it right away. Complacency is back and comes in the form of recession denial in the face of global slowing data. We didn't see the slowdown coming, but we are confident it will not produce a recession, so the narrative goes. Not even a risk of recession. You're hearing it from the Fed, the White House, the IMF, and every Wall Street firm, the ECB, the BOJ. The chorus is sung with uniformity, no recession. And don't you find that no matter where you turn, they say, yes, it's slowing. Absolutely. Yes, it's slowing. We have less growth expectations than we did last year, but no recession. Nobody out there will say that there is a recession. And why? Because there is no black swan hitting you in the face. But that's not how it works. That's not the way it happens. It doesn't ever come at you in a way that you have time to react. It's always individuals that are too complacent, they end up getting burned. There's no possible way to be able to see it before it happens. If you did, then I'm sure you'd be the one picking out the lottery numbers every week and winning the jackpot. Not only is there no recession, the slowdown creates a bullish paradox is the message. Because of the slowdown, central banks will remain accommodative and hence the global debt construct will not be further burdened by higher rates and the party can keep on going. So fear not, buy stocks. And how many times have we heard that before? The hawkish Fed is no more. Don't worry, everybody is dovish. Everybody is dovish. Oh, it's so wonderful. Doesn't that sound fantastic? The word dovish. Well, that's what we see today, and you've seen everybody from Jim Cramer all across the line telling you to buy stocks. Check out Seeking Alpha. They're telling you the top 10 stocks to buy this hour, and in 2 hours from now, it'll be a completely different list. However, that's what we get into. But how can anyone be sure that the slowdown in data will not produce a recession? After all, recessions come not only on inversions of yield curves, but historically, they are coming at the end of business cycles with low unemployment rates and waning confidence. So I'll touch on a couple points that he made here as well. We've seen just about every single yield curve invert at this time, and we've been noticing this over the last few months. It's been happening one by one, they're all inverting. That doesn't mean that a recession is going to happen the next day, but it is always a leading indicator. It is extremely telling, one of the best predictors of a recession. There are business cycles that you can see happening over and over again. And at the very end, you get the same patterns that occur. This is happening today. There's a slowdown, less confidence, more uncertainty, more volatility, not the VIX index, but real volatility. There's always tensions. There's always issues happening back and forth geopolitically. And then something snaps, something breaks, and then you have what would be known as a recession. Now, we haven't got to that recession point yet, but we have a lot of these other factors that have come up within 2018. That was completely different in 2017. Completely different story. But today, 2018, we are seeing so many of these factors piling up now that it is becoming worrisome. A lot of jobs are at stake today. I talked about this in my book about the suffering for people that have lost their jobs because of all of these financial companies that take so much risk. They push people to the absolute maximum in their debt load that they can handle. And of course, it eventually backfires. Another thing that he mentions in here is the low unemployment rates. Every time in a cycle, you see the unemployment rate going lower and lower and lower on the average, and then it drops to the bottom, and then suddenly out of nowhere, it skyrockets higher. This happens every single time. We notice this 100% of the time. Just before the recession, unemployment rate is just about the lowest it had been all throughout that cycle. Now, isn't that interesting that that's where we're at today? Unemployment rate in the US is under 4%, and it's been there for a long time, in fact. So what will happen in the future? Well, we got to see. So I have several charts to show you from different countries around the world, different economic indicators, but this is the theme. I'm just going to touch on each of them very quickly, and I'll try not to rant any further. German plunge. Factory output contracts for the first time in 4 years. You're looking at the German composite PMI, manufacturing and services. Okay, all of these different factors have contracted throughout 2018. You can see that it peaks out right at the beginning of the year in 2018, and then everything drops from that point on. Obviously, it had hit a very high point, and from there it fell. Okay, that's very clear to all of us. But they're not the only one. This happens to be France. You can see their economic output, GDP, quarterly percentage change, and as well the same thing all throughout 2018, it had fallen. Now this tells us something, that it's not just one country, and it's not even just one continent. This happens to be Singapore. In a funk, Singapore export growth slows to the weakest pace since 2016. You can see on the right hand side what had happened in the second half of 2018, declining here month after month after month. We can see that happening. Now, when this occurs, you don't need to necessarily be worried unless we are seeing a downward trend, and that's what's happening right now. So we'll get the new numbers as of early 2019. We'll add them to this, and we'll see if those trends continue or have they started to reverse. This is Japan. Japan's exports sputter. China's slowdown and possible trade issues follow, cloud the horizon. You can see that it peaked out 2017 and slowly but surely on average declining ever since. Their exports are not doing well as a result of everything we're seeing. Of course, they're mentioning China, and that is one factor, but the global economy is slowing down, and we need to be aware of that. This is China hitting the brakes. Passenger car sales in China are falling fast. Year-on-year growth, this is declining to a very low level. I did a video about this as well if you haven't seen it already, but definitely these numbers are getting worse as time goes on. That's very clear. You could see Korean exports to China in the first 20 days year over year. This goes back from 2007. Now it's looking terrible because that is a very severe decline into the negative territory. Then you look at Europe. January blues. Euro area economy weakens at the start of 2019. Euro area composite PMI is the white line, and that basically mirrors what we're seeing in Germany and France as well. So whether we look at Canada, Europe, Asia, anywhere around the world, in fact, the same statistics end up showing up. It may not be precisely the same for every single country, but the averages that we are seeing are definitely there, and it doesn't look good because it happens to correlate entirely with the quantitative tightening policy that has been in place ever since 2018. Now, while the PBOC, for example, started to inject more money than they had previously, the BOJ had printed some, the ECB still didn't stop printing as they promised they would. The Federal Reserve is still engaging in their quantitative tightening policy, and all central banks around the world are keeping an eye very closely on what the Fed does. So I think it's important to watch them, to get into their heads and try to understand where they will go with this. Will they stop their quantitative tightening policy, hold it there for a while, then when the next recession comes in, they're going to print more money, or are they just going to print more money right off the bat? We need to know this information. We need to see it when it happens. We need to try to be ahead of the game if possible. But the most important part is that you hedge your bets. You need to be able to withstand a shock, and there has never been a better time to diversify your holding. That is always the case. This is a time right now where diversification is so essential. People need to understand what a portfolio is. If it spells out FANG, then you have a big problem that is not diversified, all right? That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. So I do appreciate when everybody does that. So thank you very much. And last but not least, if you found this video informative, I know that you will find my books, The Money GPS and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books for yourself. We got the foundation, history, asset classes, how to profit, make money, reduce your debt, so much more. Check them out at the link. If you want the audiobook version, you can get that at themoneygps.com.